forecast for 2022. First, I want to start off with where we were a year ago. And in 2021, let's recap what our forecast was. We forecasted that interest rates were expected to rise at the beginning of the year and recover into the fall months. And we did pretty well with this. They actually did rise sharply through March as anticipated, but they recovered a bit earlier than we expected. They gained back most of their losses by late summer rather than waiting to the fall. So a little bit of an acceleration there. Housing forecast was for very strong demand and tight supply, which would push home prices higher. And we thought it was a pretty robust forecast, saying single-digit rise in real estate was going to be the story there, but there was such strong demand and tight supply, as well as disruptions in the supply chain by COVID, as well as labor shortage, it pushed real estate values much higher than even our robust forecast. Although a lot of people called for real estate values to drop in 2021, so we were certainly on the right side of that. But depending on the measuring stick you use, real estate values were up somewhere between either 11 to 18%. We were in the high single digits, so it outperformed even our robust forecast. Now, 2022, the Fed's going to play a major role here. We know that they've already decided that they're going to start tapering, and they're going to accelerate that tapering into 2022. That means buying less mortgage-backed securities. They said they're earmarking some rate hikes, and they're going to let their balance sheet, instead of reinvesting the mortgage bonds that pay off or principal payments, where they buy more mortgage bonds, they said that that is something they're going to contemplate, and this could have a big effect. We're going to talk about all these things. Now, the Fed's actions can definitely impact the stock market. They can drive interest rates and then affect housing and jobs. So the Fed's going to play a major role, and we're going to talk a lot about the Fed. So first of all, the Fed, which is going to be so important, their voting members, they rotate every year. There's 19 Fed members, 12 of them vote, but 4 of them rotate in and out each year. So the 2022 composition of the Fed with this rotation should be a little bit less accommodative, maybe lean a little bit more towards tightening than the batch of Fed members that were voting in 2021. Now we know inflation has really gone up quite a bit, the highest inflation numbers we've seen in 40 years. That's going to be the Fed's main focus. The stock market's reaction, if it's very negative to Fed rate hikes and fighting inflation, could cause the Fed to lose their resolve. We know that this has happened in the past. Now, the Fed really know this. They should have hiked sooner. But they mistakenly thought that inflation was transitory. Let's take a look at history, because history can help us forecast how the Fed's actions will influence the market. If we kind of think what the Fed's going to do, and we see how actions like this affected the markets in the past, it can give us some clues as to what we may be expecting going forward. So let's go all the way back to the 1970s, and here's a picture of the Fed chair, Arthur Burns, who was the Fed chair back then. He ignored inflation. It was rising rapidly, but he insisted. He said, hey, it's transitory. Does that sound familiar? Remember how many times you heard that word, right? But year-over-year inflation under Arthur Burns, it really ballooned. It went from 7% in 1978 to 14%. By the time of that, 14% inflation, okay? Now, Burns remained steadfast. He said that it was transient inflation. Mortgage rates responded, because remember, bonds, including mortgage rates, they hate inflation because it erodes the fixed return you get when you hold a mortgage. The return you get on that mortgage is fixed. So you're buying things with a fixed budget, and if the cost of those items that you're buying are rising very rapidly, it's making the value of that fixed return less and less and less over time. So the only way to help combat that is on the future loans that you do, money that you lend out, you've got to charge a higher rate. And under Arthur Burns, mortgage rates did this. Look at this. Went from 12%, very different picture than right now. I mean, man, 12% looked great, because when Arthur Burns was done, it was 18% to get a mortgage. Can you imagine 18% to get a mortgage? Now, Paul Volcker, who I did spend some time with, he came in and he wanted to fight inflation. He hiked the Fed funds rate from 11% to 20%. Now, the Fed funds rate today, as you probably know, is 0. But 11% is already much higher, but could you imagine he took it to 20% in just 2 years? My goodness, we make a big deal about a 0.25% rate hike. He hiked in 2 years 9% on the Fed funds rate, and he was very, very effective in fighting inflation by taking these drastic measures, because inflation, which remember under Arthur Burns, got up to 14%, it moved all the way down, back down to below 5%, and because inflation dropped, mortgage rates sharply declined as well. Remember, they reached 18%, they moved back down to 12. While today we say 12 isn't that great, but it's a lot better than 18. But there were consequences. You see, the S&P 500, it sharply declined by 30%. So 30% loss in stock prices during the time. And this tighter monetary policy, it pushed the United States into a recession in 1982. So 2 years later, we were facing recession, but it did slay inflation. Now, here's Alan Greenspan. Alan Greenspan was Fed chair for a long time, and in the 1990s, he saw inflation double. It went from 1.75% to 3.5%, so it rose by 1.75%. And that higher inflation caused mortgage rates to rise because, as we mentioned, investors demanded a higher return to combat the higher inflation. It went from 7% to 8.5% on a 30-year fixed-rate mortgage. Now, unlike Burns, Greenspan took action in 1999 because he saw what happened under Burns. He saw that Burns was wrong, and he wanted to be proactive, so he didn't have to get desperate like we saw happen under Paul Volcker. When Paul Volcker came in, he had to take desperate measures because Burns screwed it up. So Greenspan wanted to be proactive, and he didn't hike the Fed funds rate by 1.75%. That matched the rise you saw in inflation. So he took it from 4.75% on the Fed funds rate to 6.5%. He did that in a year. Now, inflation responded and dropped from 3.5% all the way down towards 1%. So it was very effective. And mortgage rates, they dropped too. They dropped from 8.5% on a 30-year fix down to 5.5%, and that sparked a huge refi boom back then. Now, there were also consequences when Alan Greenspan did this. You see, the S&P fell by 50% from the spring to the fall. In just 6 months, the S&P lost half its value. Really painful. 2000. And then the U.S. entered a recession in 2001. So we have to fight inflation. Twice the stock market didn't like it. Twice we entered a recession. Now today, Jerome Powell, who I also got a chance to spend some time with, he saw inflation increase in 2021 for about 1.75%, but he let it go all the way up to 7%. Really got out of hand. Powell thought it was transitory. Remember, he kept saying transitory, just like Arthur Burns did. Greenspan seemed to learn, but Powell fell into the same trap as Arthur Burns. Now, the higher inflation caused mortgage rates to rise from very, very low levels of 2.5% to about 3 3/8 towards the end of 2021. And seeing that rise, obviously, is because inflation was rising. Now, the Fed started just at the end of 2021 tapering their purchase of mortgage bonds and treasuries. They are not going to do two things at once. They're not going to hike and reduce purchases at the same time. So they're going to reduce purchases. They're going to taper first. And then the next thing is, when they're done tapering in March, they're likely to begin hiking, more than likely in May. That's where it will coincide with a Fed meeting. That could happen earlier, but we think that early May could be a potential time when the Fed starts hiking rates. They're targeting about 3 hikes in 2022, and then maybe some more in 2023. Inflation and interest rates, they can still rise until the Fed acts, because inflation should rise through February. So that's going to make it a little bit hard on the mortgage-backed security market, especially at the same time that the Fed's tapering. Now, the Fed can be successful. If they can tame inflation, mortgage rates, they really should drop, but they may drop from higher levels first. Now, let's say if we see a pattern here. So here's the Fed chair. We have the period of time from Burns to Volcker, and then we have Greenspan and Jerome Powell. So you can see where inflation went under Burns before Volcker came in, and under Greenspan, and right now under Jerome Powell. So mortgage rates rose because inflation rose. 7 to 14 year on inflation, mortgage rates went from 12 to 18. Under Alan Greenspan, we saw mortgage rates rise as well by 1.5% as inflation rose by 1.75. Now, it's kind of a muted response right now, but remember, the Fed is buying a lot of mortgage bonds, and that's helping to keep rates low. But the Fed will start tapering, and there's those reinvestments they might decide to do later on. They might decide to stop doing that later on. That could have an impact. So you can see here how mortgage rates are not really responding the way they did in the past by going up a lot, but they are still being pressured higher from very low levels. Then the Fed funds rate under Volcker jumped from 11 to 20, as we said. Under Greenspan, went from 4.75 to 6.5. And in 2022, the Fed is anticipating that we'll move towards 1% from near zero. So we'll have to see how this plays out, but our forecast is they'll move towards 1%. Whether they reach 1%, we don't know. The Fed may lose resolve, but the goal is for the Fed to get it around there. Now, the response in inflation in the past to Fed rate hikes was very good. We saw a big drop in inflation under Volcker, a big drop in inflation under Greenspan, and they should drop under Jerome Powell if the Fed remains with their plan to hike rates in 2023. about the same, about the third of the rate was shaved off. Now here they should decline as inflation declines. That means we could be back under 3%, should be back under 3% as inflation declines, except that we could see rates rise a little bit more if the Fed is slow in their entry into starting to hike rates. Now, the consequences that we've seen in the past, well, stocks drop by 30% under Volcker, then we have a recession. Under Greenspan, they drop by 50% and recession. Stocks are very expensive now. The economy is slowing, so could there be a stock market decline with these Fed rate hikes, and could we enter a recession? I have to say that these are really good possibilities to see happen. Now, so the wild cards are, of course, COVID. This is going to have a major impact on the supply chain. So a change in COVID is that we don't see on the horizon right now could change this outlook dramatically, could play a big role. And stimulus that could happen during 2022 could mean more inflation fears. It could push stock prices temporarily higher, and it could cause mortgage rates to rise further. It will make the Fed's job of corralling inflation much more difficult. Maybe in the short term we get a boost in the stock market and the economy, but it could make it hard for the Fed to get inflation back in check. And mortgage bonds probably won't like that. Now, the runoff of the Fed's balance sheet that I mentioned earlier, that's going to be very important because the Fed right now is buying about $70 billion a month in mortgage-backed securities. That's a result of people paying off their mortgage by a refinance or by selling their homes, or just the principal payments. Remember, the Fed has several $1 trillion on their balance sheet of mortgages that they're holding. So the first step is to stop purchasing mortgage bonds and treasuries. They should end that in March. The next step will be to start hiking the Fed's funds rate, and they will begin that likely in the spring, perhaps in May. But the Fed will still be buying that $70 billion. If they stop that, well, that can push mortgage rates higher than previously thought. So we'll have to consider that a wild card. Now, stocks, in the meanwhile, are very, very expensive. This is, by almost every measure, the most expensive stock market that's out there. And because stocks are so high, and if the Fed hikes, then we understand that the stock market historically doesn't like that, it could reduce the price to earnings multiples that are out there, so we could see the stock market contract. Our forecast is that 2022 will likely see near a 10% decline in stocks, maybe a little more, maybe a little less, but we're seeing that there will be a 10% drop in stock prices during 2022 because the Fed will be less accommodative. Now, our interest rate forecast, we think that interest rates rise along with inflation during the first part of the year. When we get to the mid-threes, maybe in that 3 3/4 range, we think it's quite possible because we think inflation will continue to heat up into February, and we believe that mortgage-backed securities probably won't love that, especially as I mentioned earlier, with the Fed tapering at the same time. So we think that the softer stock market and slow economic conditions that should happen later in the year will help mortgage rates, and they potentially, it should, head lower, perhaps towards 3%. We don't know if they get there, but perhaps towards 3%. Maybe they get a little under 3%, but we think that longer term it's a very good refinance opportunity later on in the year. See, we think rates go up a little bit, but then come down, and strategically, don't take as many upfront fees. Don't look for the lowest rate. Take the lowest cost because there could be a big refinance opportunity later in 2022. Timing is always difficult, but we think this looks really good if the Fed continues to fight inflation. Now, housing should remain really strong in 2022, but not as strong as 2021. Demand's going to be slightly softer due to the rise in interest rates at the beginning of the year, but still really robust. Supply is going to increase a little bit as supply chain hopefully eases up. Remember the wild card of COVID, but it's going to remain tight. Labor force disruptions in the supply chain, semiconductor shortages help hurt new construction because you need semiconductors because homes are driven by computers. You know, the refrigerators, the washer dryers, the dishwashers, they all need computer chips. So this will all play a role. Now, rents are going to continue to rise. Rents have been rising at a dramatic pace. They're going to remain above 5% on the increases for rents. That's going to push a lot of people to see the benefit in buying. Our forecast is for mid to high single-digit appreciation, so a lot of wealth creation in real estate. This to us looks like, while difficult, still a really good time to be a buyer. Hope you've enjoyed this presentation.